South Coast Commercial, meeting with John Lloyd from Fidelis Private Fund. Have a fun little interview today, learning about what's going on with Fidelis, a little background on private financing versus commercial financing or conventional financing. And it's interesting times right now with you coming in with what's going on with all the most recent news.
It's crazy times. But yeah, Fidelis Private Fund, we're a mortgage fund where we take investors' capital, turn around and lend it out in short-term loans. So that's sort of our investment properties. So that's sort of the structure of Fidelis. And we started about almost 4 years ago, and we're up to about 50 million in capital and really active in doing bridge financing. We don't do any long-term, just strictly bridge stuff where, you know, you got to close fast or there's some added value component to the deal. That's sort of our niche, and this time right now is great because the banks are tightening up and it's producing a lot of volume for private lenders.
Absolutely. I was just looking at one of the most recent articles with another bank here locally, First Republic. A little news out there this week.
I mean, yeah, this banking crisis, and it's crazy because it's all built on confidence. Because every bank, if you have a run on a bank, there's no bank that can withstand a run, and then no bank keeps their money in deposits sitting there in cash. It's lent out. So I think with this social media, Twitter and everything, and how fast people communicate, I think it's a new paradigm for banks, because if they get word that the bank isn't that solid, man, they could be in trouble fast with the way communication is through social media. And I think it was just happened, you know. And I think First Republic is a solid bank, good loans, solid assets. There's no reason to be a run on the bank, but other than fear.
So you brought up a few things, and I want to dive into them. One, we're talking about bridge financing, short-term financing, a run on a bank. So first, what is a run on a bank?
The whole premise of a bank is to take people's money and make it safe and give them a good return. But how do they give them a good return? They loan it out. So the money is not sitting at the bank, and they're supposed to keep a small amount of reserves to function for daily, you know, with a modest amount of withdrawals. But if that's how a bank takes people's deposits, like Fidelis, we're an investment, we're a mortgage fund. We take investors' capital and loan it out in short-term loans. And so we don't keep any cash. We have a line of credit where we use for liquidity, but that money's lent out working for our investors. That's how we maximize the return. A bank maximizes the return to their shareholders by lending it out. And so I think with this crisis recently, with SVB and you know, First Republic being sort of run, they had their cash invested in bonds and securities. SVB didn't have too much cash liquidity, and so when they had a run, they had to sell bonds that were bought they had to sell at a discount, so they just couldn't withstand the run. And again, no bank could withstand the run. I think the confidence in the system, in the banking system, is crucial for functioning. Our economy is fragile. Really, it shows how fragile our banking system is, because with the slightest Twitter comment could trigger an avalanche of fear, and people make a run for no reason other than panic. And so I think that's something banks are going to have to look at moving forward.
And tell me a little bit about yourself. Let's start with John. So you've been in the business for about 30 years. You know, we could all look at your bio. I've done a number of deals with you personally. You know pretty much everybody here at South Coast Commercial. You've been in the business before I've been in the business. And then if anybody needs private financing or hard money, they call John.
Okay, well,
so
anyway, I graduated from University of Montana, so I'm from Montana. Came down to California after I graduated, got into banking, real estate lending, worked for 12 years in banking, and then I got frustrated with the bureaucracy of banks, and I elected to go off with the client, and we started a fund, and from there I worked at a fund for about 12 years where we grew it from 30 million to 190 million in capital, and then I left 4 years ago and started my own private fund with some other partners, Fidelis Private Fund, and we're currently around 50 million. And so just going back, I always in real estate lending, financing, brokerage, also broker loans. So I've been in the business a long time, and having that banking background has helped me in the private lending, knowing sort of what the competition is and how much better we are than conventional lenders as far as convenience, timing, the bureaucracy, and really what does a borrower need to provide. Do they need all this minutia that the bank's requesting on every entity they have or every bank account they've ever had? It totally makes getting a loan from a conventional lender difficult, which allows private money like us, where we just dig into the facts on the real estate and just the basic information we need on the borrower and make it easy, fast. And so yeah, our niche is, again, bridge financing, smaller deals where investors need to close fast. Say they get an opportunity to buy a property and they get a huge discount, and so they got to close in 2 weeks. That's where we would come in.
2 weeks.
You know, we can close in a matter of days.
Got
So
it.
I've closed in 3 days from the first phone call. You know, the prelim was ready, the title was ready, but that's all we needed. And is, hey, relationship, do I know the borrower, and is it good real estate, and we can close on it. And so that's an advantage I think we have.
So, okay, John, so on timing of the loan, we have all of our ducks in a row, meaning the borrower, the broker, we send our entire package over to you, 12-month income expenses, P&Ls, couple tax returns, and tell me about how the process would go for it, and tell me about your standard loan. What is a standard loan? You mentioned a small deal. Is that $100 million? Is that $1 million? $500,000?
Yeah, so typically a small deal for us is anywhere from 100,000 to 2 million.
Okay.
And our niche is around $1 million or a little less. So the typical deal is, right now, it's these ADUs, adding additional units, increasing density, and so we'll get buyers that buy a property, want to buy maybe a single family home that has capacity to add units. That's a typical we're doing a lot of those. So they come in, the seller is selling it as a single family residence, and they don't really understand the value they have because of the capacity, the density you could add to it. They sell it to the investor, and then he turns around and, the best situation is to add more than make it a multifamily property, not a 1 to 4, but a 5 unit plus.
So turning the single family home into 5+ units.
Yeah, that's the optimal.
All right.
Because 1 to 4 is the value. You get more value on a multifamily property than you do a 1 to 4.
And so ADUs is the hot ticket right now. Everybody's talking ADUs. So you're lending a bridge financing. Explain to me the bridge financing on an ADU development project. I have a house in Claremont, and I want to, big lot, small house, I want to add as many units as possible. Call it 4 more units.
Okay, so they come in, they say the house sells for $900,000. We'll come in, make a loan for an acquisition, say 70% of the purchase price. We'll come in, do the acquisition loan, and then most likely that it's going to take them about 6 to 8 months to get their permits. So we'll make the loan, and then they rent it out until they get their permits, and then we'll come in and we'll modify the loan for the construction. So at that time, we don't know what the costs are when they buy it. They don't know whether they can put 4 units or 5 or 3, but they know they can put some units on it. So we don't get into the construction loan until after, which is a benefit to the borrower, because they don't have to do all the upfront work, and they don't have to pay for the costs of it or anything. They just pay for the acquisition loan, and then the second stage would be the construction piece. They bring in okay, this is what's going to cost, and then we look at the value, and we help. Usually, we can do 100% of the construction cost if they add enough value. Our value needs to be 60 to 65% loan to value on the backside. But again, another underwriting criteria we use, we look at what the end loan can underwrite from a conventional lender. So what's the exit strategy? We need to know what the exit is. If it's a sale, we may be a little more flexible on the underwriting, but if it's a refi or underwrite, what can you refi this loan for? Assume we build 4 units and make it 5, and here's the pro forma, here's the cash flow, here's the NOI. But what's the loan I could generate on that? And so I look at that loan amount. That's going to dictate what my construction loan amount is going to be.
And you have good experience in that banking industry from your previous.
Yeah, because
so
I do
exactly
both.
What they're going to be.
So I know what the end loan is and how they underwrite, how it's structured. So I want to get structured. So I structure my loan to make sure I can get out, and make sure I protect my investors for, just the asset to make sure we're safe.
So on these short-term bridge financing, fix and flip type loans, I hear loan to cost, or is that a 30%? So is that a loan to cost versus like a loan to value? What's the difference with like a loan to cost on that build out?
Okay, I'm not too concerned on loan to cost from a private. I mean, that's where banks get tied up. They're like, we don't care. We're not going to lend more than 75-80% of the cost, regardless of what the value is.
Right.
So you could have created all kinds of value, but that's a limiting factor from a bank standpoint. We look at, more what the cash flow. But somebody could create a huge amount of value, and the cost was maybe they got the deal at a discount, maybe they got the deal under market. They purchased it at a lower cost. That shouldn't go against them.
Yeah,
and limit
absolutely.
them.
So
Yeah.
you're basing it on the deal.
Yeah, on the value, not the cost. But I do have to look at what the end loan lenders do, because on construction loans, lenders really, especially if you've only owned it a year or two, a year to year and a half, they don't really care what value you created.
Right.
They look at what it cost you, and so after 2 years though on a refi, banks don't consider the loan to cost. So it's sort of what I'm saying is that I do have to consider what the banks do and how they underwrite when I do my underwriting, if that's my exit. If my exit strategy is a conventional takeout, I have to sort of underwrite to them. But from my underwriting standpoint, if somebody's going to turn around and sell the property, loan to cost doesn't matter as long as the loan to value works for me.
So.
And cash flow, if it cash flows, from.
So John, you're looking at the deal when you lend money out. You're looking at as if you were buying the property yourself almost. You're looking at from what I'm hearing, you're looking at not a partnership. I hate using the word partnership and the formality of it, but it sounds like I'm getting at the security the loans you're doing. Sometimes people hear private money, hard money, they think like predatory, like he just wants to take my property. It looks like you're looking at it from a standpoint of the return, obviously, for your fund, but also securing the success to the best of your ability that the developer or the borrower can accomplish their goals.
Yeah, I mean, it's real estate. I gotta want to have secure real estate. That's a key thing. It's almost more important is relationships, people. So what I've learned over the years is I don't care how good a loan to value or how low it is, if it's not the right person and I don't trust them and don't have good feel about the people, then I don't do the deal. And that's relationships override everything, and people. So from my standpoint, that's what this lending business is. An art. It's not a science. It's the science of the banks look at the check this box, credit score, For me, it's those do have an impact, but hey, somebody could have a bad credit score. Maybe they had a medical issue that they had to file bankruptcy for some reason outside their control, I'd look past that, dig in and find out why, what happened, and then who that person is. And if I've done business with somebody, repeat business, I could get the phone call from a guy who I've known a long time and trust them, understand their judgment is good, and they present me a deal. I'm like, it's a done deal, almost because of just the people.
Right.
I've always got to check on the real estate to make sure it works, but it's about people more than checking the box.
So as far as, I mean, we're all, okay, private financing, hard money, we're all curious with how, obviously it's a more convenient loan. It's a short-term financing. You're lending it, your value is based on the real estate, it's tied to the real estate. Let's talk about fees, cost. I mean, why would I go to private financing? How much extra is it going to cost me, John, to do a private loan versus going to Bank of America and getting myself a 30-year fixed? That's going to make me jump through all these hoops.
Well, the advantage, the smart investors look at the big picture. Mm-hmm. The guys that get hung up on, is it the fee and the rate, I think miss the big picture, because our loans are only short term.
Right.
I mean, you could be paying 10, 11%, but it's only for months.
Mm-hmm.
But if you get a good deal and acquire a property at a couple $100,000 discount, who cares what the rate is?
Right.
But because you're going to get in, acquire the property, and do what you need to do to get out, and it's only short term. So I think the costs on our deals are, right now, the rates have gone up. We're 11%, a couple points. If less than that, if it's less than a year, we're 1 to 1.5. But that's where the market is right now.
Yeah.
It is higher than conventional, but the conventional, I mean, you have brain damage that people don't want to go through, and it takes months to get conventional financing, and you sometimes lose the opportunity.
So John, other than the brain damage on the typical conventional loan, which I'm fully aware of, there's also other restraints like the number of loans that you have, or more than 10 residential loans or 4 residential loans. Are there those types of constraints with private financing?
Again, to me, it's security for my investors in my fund. Is it good real estate? Is there an exit strategy? Am I getting paid back? I need to know the exit strategy, and am I working with good people? And those, as long as I do that, then I'm not worried, because the exit strategy might be if a guy has too many properties, he may not be able to get a conventional loan. So I make him the loan, and maybe he has too many to get that.
Right.
But there's other options to get him out. So there's other lenders. So that's one advantage we have is, as a direct lender, we help bridge financing, but also broker at the end. I help people get long-term loans, and I've got a lot of lender relationships, and I can say, hey, this would best fit this lender, or this would best fit this one based on qualifications.
Okay, so John, we talked a lot about the debt. Now, a private fund has investors. Tell me a little background on, let's just say I wanted to be one of your investors. I wanted to give you money to lend to somebody else, like a broker or a borrower. Okay. How would that work?
Okay, so yeah, I've got two sets of, I have borrowers that I lend to, and then I have investors who invest in the fund, just like a bank. Depositors are my investors, and my borrowers I lend to. So we're structured as a limited partnership. So we take limited partners, and we want investors who have a long-term approach to investment, not the short term. Our fund isn't a high interest paying checking account. It's for people that want to invest long term to preserve their capital and for fixed income, or maybe compound for growth. So it's a long-term investor. The minimum investment is $50,000. So you come in with $50,000. Our average investor is about $500,000, and they want some retirement profit sharing plans, IRAs work. Somebody that wants to invest long term. So that's sort of our money. Our investors come in, and we require, again, a minimum of 1 year. So really, it's a longer term approach, and we want really investors in there for years, not months. You know, just because our loans are lent out, you know, the money's lent out over a year to two, and we just want investors in there for the longer term. So let's see, and then, you know, our returns to our investors, we've been over 8% annualized returns to our investors since we started in 2019. So right now we're 8.5 plus, which is a good return. So it's all those are secured by, you know, real estate investment properties. Mostly our first trust deeds. We do have a few second trust deeds, but mostly all. And if we do a second, it's underwritten as a first. So it has to be a small first trust deed, and with the two combined, it would be as if we're doing a first as far as security goes.
8% is a pretty good return.
Yeah, I mean, and consistently. So somebody's looking to, compounding.
Yeah.
You know, in 7 years, your money doubles. At 8% to 9%, your money doubles in 7 to 8 years. So the compounding effect of our fund, we're a bank, you can't compound. It's interest, you know, it doesn't, you know, it's in our fund it has that advantage of being able to get interest income for people who are retired, and maybe they want the interest income, or the ones that don't need it, let it compound, and it grows fast.
So John, you mentioned being able to invest from like an IRA, or are you? So I would not just have to give you $500,000 out of my checking account. I could turn over an IRA, or how would something like that work?
Self-directed IRA.
Okay.
So you could set up you have a custodian, and just funnel it. Just tell them, hey, I want to put money from my IRA into this Fidelis, and we have various custodians we go through, third party, and you get it to them, and they get it to us. So yeah, that's about 15 to 20% of our fund is in profit sharing and IRA money, and that's and with right now the stock market and the volatility and the losses in the stock market, it's been a real advantage to be in a fixed, consistent return secured by hard assets, real estate. I mean, what's the worst that can happen in our fund? We foreclose on everything, and we own all the real estate. Our investors, limited partners, own all the real estate, and we become a property manager in San Diego real estate. I mean, the thing about, where stock market, a company, SVB, Silicon Valley Bank, went to zero value. The shareholders, and so an investor, yeah, they did, the government backed them, but just a point on a company in on a stock exchange, they could go down to zero, where real estate is never going to go to zero. And
we're in San Diego.
Yeah, I mean, I managed a fund through the worst recession ever in 2008 to 9 to 10, and our fund that I managed didn't lose one dime of capital. And reason being, we were patient, we were able to wait, and where the banks back then, they just foreclose on everything right away, because real estate eventually is going to go back up. That's all you do, is have to be patient. And so the advantage of a fund like ours is we don't have to, we do what's best interest of our investors. And if something happened like that, where values went down 50% like they did in 08, you just ride it out. You modify the notes, your returns might go down a little bit, but your asset value is always going to go back up.
So if I was one of your investors, hypothetically, or I have a client who wants to take $250,000 and invest it to get a 8%, 7% return, I would sit them down with you. You would talk to them. How would they? Do they get dividends? Does it compound? If I give you $500,000, am I getting $40,000 a year? How would that work if I was one of your investors?
So investor comes in, and the money immediately goes in the fund the first day of the following month. So this month, if it goes in, it would go in the first of next month, and then we the interest is compounded monthly, paid quarterly if you elect. So you can either elect to have interest income, and if you do, if you elect that, then it's paid every quarter, compounded monthly. And if you elect to compound, the money just stays in your account. We have an online portal where you can go on. It's like a bank. You check your account, check the statements, your K1, or tax, the financial statements of the fund, the audit report, just all the stuff and how we're doing this month. You sort of go online and check that, and so and it's all backed by mostly San Diego real estate.
Sounds like a lot of benefits to go on private financing, especially today.
I mean, you can't. I mean, these banks, you think, oh, they're so secure, but the advantage of a fund like ours versus a bank is our investors. If we have a run, just like a bank, if all of our investors called and said they wanted their money back, one, it's lent out because I can't give it back right away, and I just tell them, hey, I mean, it's based on availability. So the only disadvantage of a fund like ours is it's not immediately liquid, because it's working for you and it's earning a good return, and so if we get requests for funds, which people have issues and they need their money back sometimes. It's not like after a year you can request your money, and we just put it in the queue and make sure that we allocate for that when we have the funds available. So, and usually that's 1 to 3 months, depending on how much it is. So it's just we'll never have a run, because as a manager of the fund, I'm protecting the whole partnership,
right?
Everybody.
Right.
And so I can say, no, we can't give that out to you now because it's going to jeopardize everybody else. And unlike a bank, they don't have that luxury. They have to give it back, and they jeopardize everybody in the bank. And that's a thing it's a benefit that we have to protect everyone, is that we can give it back when we get it back, because it's out working. Just like a bank, the bank doesn't have all the funds at the bank. It's lent out. And so, anyways.
How are things looking today? How are things looking today with your financing and your fund? If we were to say, hey, we got a bunch of deals right now, we need to go. What are you seeing coming across your desk today? Current volume, volatility, market conditions. What's the outlook? What's John's crystal ball for today and the next 12 months?
It's interesting with this, because I've been through these cycles before, and they generate high demand for private money. And so right now I've got more deals than I have capital. So I'm cherry picking deals, and unfortunately I can't help everybody, but just because of our size. But I'm seeing a lot of acquisitions for added value. Like I was saying about ADUs, and I'm seeing multifamily vacancies are tight. Inventories are low. There's still room for expansion in multifamily and housing, and so we're seeing a lot of added value type deals. I just with this, the new legislation on allowing more density has just been huge.
And mandatory for San Diego. We need housing.
Yeah, because people will call me up, John, I'm looking through my portfolio, and I'm looking at these properties, and every one of them has capacity to add units. I mean, it's like this one, I could put 3 on this one, I could put 4 or 5 on this one, I could do this, because before you couldn't. Right. And so now I'm seeing a lot of investors come back and say, I want to add value to my property, and I don't want to, the banks are wish-washy and aren't providing me the, what I need, and so they go to private money. And again, it's short term, so the costs are higher, but when you're adding value like that, it easily absorbs that cost.
John, I want to hear about John. You have when I think of hard money, I don't envision John. You're a nice, clean cut guy, good shape. I'm thinking like gold chains, What's going on? Tell me, what are your hobbies? What do you do outside the office that keeps that stress level tolerable? You just named a ton of stuff that you do during the workday.
Well, I think, again, I sort of go back to relationships is huge for me. I mean, as far as just, developing those relations over time, communicating with people, that's sort of my passion. I like to help people. I like to help people in business, through real estate, but I also like to help them individually, professionally, and personally, to help them grow, to be better, maximize their potential. So I just want to help people, and real estate is one way to do it. As far as what I do, I'm a tennis player. I played tennis in college, so I play tennis, I run. I really, to reduce stress, I love getting out and enjoying God's creation and running trails. And I've done numerous ultra marathons. I've done a 100-miler. I just love getting outside. But I think what drives me is just the challenge of it, and I love a challenge. And whether it's trying to help somebody a certain way, or trying to run, the Grand Canyon. I was just at the Grand Canyon last week, and I did about 20-mile run down to the canyon, back out, and I do it every
Ran the Grand Canyon.
Yeah.
So I saw that on your website. 100 and I thought it was a typo. So there's such thing as an ultra. I mean, a marathon to me sounds like an ultra marathon. What the heck is an ultra marathon? There's more than a marathon?
Ultra marathon is anything over 26 miles, and usually it's a 50K, which is about a 30-some mile run.
Is that broken out over the weekend?
No, that's one run.
That's
yeah. So I've done a dozen 50-milers, and they take about a day usually. Pretty much. Depends on the difficulty and the challenge and the elevation, the climb, but 10 hours or so is a 50-miler, and then 100 takes about 24 hours. And so you run all night. It's really a challenge. I don't know. I don't think I'd do it again, but I did it. I finished, in the top third of my group. Of the whole, out of 170, I finished like 23rd.
Wow.
Yeah. What was that? This was 2013. So this was 10 years ago.
So I'm thinking 100 plus miles. Where is something like that? Where would that take place?
This was in the Laguna Mountains.
Oh, mountains.
Yeah.
Why not?
Yeah. This had about 18,000 feet of elevation climb. So you go huge. I mean, it's not just. Yeah, it's not flat. I don't like flat pavement. Yeah. Only time I run is on trails.
Trail running.
So.
So some people run marathons, but you run ultra marathons.
Yeah.
50 double marathons.
Now the Grand Canyon, I've done that rim to rim to rim, which is 42 miles, going from the south rim to the north rim back.
Wow.
That takes about, and that's. Have you ever hiked the Grand Canyon?
I haven't, but it is a personal goal.
Yeah.
I don't think I'd be running it, but I commend you for doing that.
It's a challenge. I love to get outside. I love the challenge of it. I think that's why I do it.
John, what did I miss? I appreciate the time. What else is going on in the world of San Diego, multifamily, interest rates, the crystal ball? I imagine we have interesting times coming up here. Our deal volumes have slowed, but they're not halting by any means. I see a lot of good deals still flowing through our office. All of our guys are on the phones cold calling and warm calling clients, and I know that we call you on a handful of these deals right away. I know you see more deals, and I should be asking you where all the good deals are right now.
Well, I mean, we're not for everyone. Ours is just a niche. We have a niche to fit the right type of borrower. But I think right now what I'm concerned about is the banking system functioning and the confidence with everyone, because we can't do more multifamily deals, and you can't do unless we get these lenders lending. And
Right.
like First Republic is sort of almost stop lending right now. I mean, I called them yesterday on a deal, and their rates were almost private money rates. I mean, it's like,
7% or something.
yeah, it's like, and it basically they're saying they're not doing any
Yeah.
lending.
Yeah.
And so that's what I'm afraid of is other banks, if we have some more runs on banks, their deposits will go down, which means they can't lend because their loan to deposit ratio is going to be off. So these banks need to lend for us to we do short-term bridge financing. I got to get taken out. I need these banks to be taking me out for me to do my
Right.
deals.
Your exit.
Yeah, the exit. And so we need it. That's what needs to happen is the system needs to get back to normal for everything to be working. And so I don't know. I think it will. I think it just takes some time. The Fed again just increased rates today, another quarter, which they telegraphed that, and they had to sort of just to maintain their credibility. But I don't think we've seen the worst because there's always a lag. Back in 2006, I remember they started increasing rates. Nothing, no effect. 2007, not really much. Boom, it hit. And we've only been in this a year, and so I don't think we've seen the damage to the economy that these rates have done. So I'm sort of worried about that. But I just, like you said, I think there's a lot of deals to be done still. Vacancies, tight. Inventories are low. So if we can still have, the banks lending, we need that. So I'm optimistic. I'm excited about because through crisis that's where opportunities are, and I sort of like them. I mean, for us, oh great, the recession's coming because there'll be more deals for us, better
Right.
opportunities, better prices. We just need to underwrite our deals right, and that's it's a lot of fun because I get to help borrowers not only increase their portfolios, increase their standard of living, but I get to help investors give them a great return through Fidelis. So I'm having fun, liking what I'm doing, and helping people at the same time.
So, John, we get a lot of brokers coming across deals, and they want to line up private financing. You're obviously a very approachable person. How do brokers and clients get a hold of you? Can anybody call you and say, I have a client needing a loan?
Yeah, I mean, we just our website fidelispf.com, and just call me. Best thing to do is run the deal by me. I'll tell you right off, hey, this is something we can do. This is something we can't. And if we can't, I've got all kinds of sources for the people. So if it's a deal doesn't fit Fidelis, I'll say, oh, that might be good for this lender, and I connect them. So my goal is to help people achieve their financial goals, whether that's the borrower or the investor, but helping them. So just call me, run the deal by me, and I'll tell you if it's a fit.
This has been awesome. I learned more about you today than all the deals that we've done together.
So yeah, I've enjoyed done some deals. I've known Brian for almost over 10 years, and we did some deals, back to the last cycle, and this we're coming up with some more possible opportunities this next cycle.
Yeah, I could contest. You're definitely when I have a deal that I'm looking at, you're the first person I call. I know that you're a proven closer. That's the main thing for me, and I hope that's based on our relationship. Apparently.
No, it's
I call
again.
John, and
Yeah.
hey, if John's gonna do it, then it's done.
Yeah.
I mean, I feel confident being able to write, all cash offers, knowing that I could either close it all cash or call you in and have it done in the same amount of time, a couple weeks.
And again, it's that relationships, and when you call me and say, John, I got a deal, I already know it's a good deal because of who it's coming from.
Right.
So I don't have to, and I just need to have the money available, and that's where I think for me right now the challenge is I need more capital. So I'm looking for investors so I can lend out more, because I'm seeing this next cycle is going to be some good lending opportunities. There's no better time to lend is in a down cycle, because when you lend on a down cycle, the banks they don't understand that, because I don't know why, but you lend on a down cycle, the values are low, they're only going to go up. So as you make a loan, your equity is just going to grow.
Right.
And it just makes sense, you know.
So let's get you some more investors.
Yeah, that's what I'm looking for.
And then we'll do more loans.
Yeah.
Hey, I appreciate your time. Anything else that I missed here? I think that this was just a great interview, and I'm glad you came into our little humble shop over here.
No, I think you guys do a great job. Your team of brokers and your property managers and South Coast Commercial is awesome. And I know I've worked with several of your brokers individually doing deals. In fact, you know, a couple of them, I got one as an investor is in Fidelis. So, anyways, thanks for having me.
Hey, I appreciate everything, and thanks for listening in, everybody, with John with Fidelis. Go ahead and give him a call. Follow us on our links below. I think this is a great time, and
awesome.
let's keep
Thanks.
doing deals.
Okay.
All right.
All right.